Hello and welcome. You're watching us here on Chartbusters on CNBC-TV18. We've seen a bit of a downtick at the start. A 100-point decline is what we've seen on the Nifty. The Nifty banked down about 0.5%. The mid-cap index, which outperformed all through last week, has taken a bit of a backseat today. More stocks declining than advancing. Where do we go from here is the big question. But until then, we have a bunch of corporates joining us today. Let's start with Metropolis Health. Reported a weak operational performance in the third quarter, with the revenue falling both year-on-year as well as a sequential basis. A large part of the decline also was on account of the non-growth or a big decline in the COVID-related portfolio. But ex of COVID, there has been a bit of growth. We do have with us Ameera Shah, who's the promoter and managing director of Metropolis Healthcare, joining in to discuss the quarter gone by, but more importantly, the outlook for the future. The stock doing well in today's trading session. Thanks a lot, Ameera, for joining in. Before we talk about numbers, etc., in November, we had the news of IT raids being conducted at your premises. Just wanted your thoughts on what was the outcome of that, and have you received any notice from them thereafter, before we talk about the numbers?
Hi, good morning. There was a search operation, as we informed and intimated SEBI, that happened in November. And as we informed, there were absolutely zero unaccounted assets seized by any tax department. In fact, this is the, I think, 8th company in healthcare which has had a search operation in the last 8 to 9 months. And if there's any up-to-date beyond that, we will be informing SEBI first, obviously. At this point of time, there has been no tax demand made.
Okay, all right. So pretty clear on that front. Ameera, thanks so much for clarifying on that. Let's focus on business then. For the past quarter, your margins were in the vicinity of around 25%. Give and take everything with pricing, with volumes, with higher cost. Where do you see that number headed? What's the band you'd like to guide?
So currently, if you look at it, if you keep aside COVID, because obviously COVID was there in the base year, which none of us can do much about, but we've seen a 20% growth year-on-year, excluding COVID, as a part of our revenue growth. And I think investors, from what we hear, have been comfortable with that growth. Margin also we have sustained. Actually, if you look at the margin, there are two parts of it. One is the reported EBITDA. There is an operating EBITDA, and there's an EBITDA before sort of ESOP. But if you look at the operating EBITDA level, we are actually doing well. We've maintained our margins. This quarter, we've also come out at operating EBITDA level of 28%. We have had a dilution of about 1.3% because of new labs that we have started, and obviously which have added losses and not given immediate profits. But overall, we've been able to protect margins and be able to sustain margins, and we believe we can do so going forward as well.
Right. I just wanted two numbers from you, or in terms of thoughts, if you could guide the street. The first one is that you've been ramping up your stores and your reach. What is the contribution, the expected contribution from new network, which is currently about 3% of your sales? Secondly, premium wellness, which is about 13% of your sales, obviously has much better realization and margin metrics. 26 crores is what it did in the third quarter. What is its contribution likely to be going forward? So on new network contribution from 3%, where does it go? And the same for premium wellness, from 13%, where does it go?
So our goal is to move the wellness category closer to a sort of a 20% number, and over the next few years, and that's what we are moving towards. We've already seen it move from 10 to 13% from last quarter, last year to this year. So obviously that's an area that's growing for us. The new network, the new lab network, we had planned and given a goal of starting 90 new labs and 1,800 new centers in 4 years by 2025. We are well on track to do that. But obviously what that means is short term, there is a dilution of some percentage of EBITDA, but we know that in 2 years after starting, those labs move into sort of a profit zone. So it's really about making those seeds of investment today and reaping them in the future. And we are continuing to do that and still being able to protect our margins on the more mature labs and collection centers.
All right, Ameera, what about realizations? I think they're in the vicinity of around 950 rupees odd. Where do you see that number headed?
So we've seen about 3% increase year-on-year on revenue per patient from last year, the same quarter. So again, I think we're very comfortable with the numbers and the KPI, the way it's tracking. I think we would hopefully continue to see, as the product mix keeps changing and we keep moving up and up the value chain. As we know, Metropolis is respected as sort of the highest quality player in India in pathology, and therefore people want to send to us very complicated, advanced, specialized tests beyond the routine that they can trust their lives with. So as that product mix keeps increasing, we will see the RPT keep on moving up.
All right, and final question before we let you go, Ameera. The last 8 or 9 quarters, every quarter has been marred by some sort of COVID-related disruption, etc., and as a result of which, it's had an impact on your numbers as well. But hoping and praying that the worst is behind us. Going forward, what's a sustainable growth rate that we can foresee for your business because of the triggers that you've spoken about, the drivers? Increased stores, increased revenue coming in from the premium healthcare, etc. business as well. A lot of your new stores turning profitable. What's a sustainable growth rate and a targeted improvement in the margins per quarter going forward, adjusted for everything? What's your target?
So if we keep aside acquisition, we keep aside COVID, we keep aside even the government contracts, which tend to be in larger pieces, 9 months we've actually seen our core business grow at about the mid-teen level year on year. And I think, that's the historic trend, obviously, that we would like to continue into the next year as well and continue to protect margins as they are. So I think, we've had a challenging year from many aspects, lots of external threats. But I've seen Metropolis come out of all of that still, swinging and doing well. And I'm definitely confident that we will continue that into the next year.
And what do you mean by protect margins? I mean, 27% is the adjusted margin that you've reported. Going forward, there are triggers from new stores turning operationally profitable and higher contribution from the other businesses. So is there a case for margins to go higher and sustain around those 30% levels?
They were never 30% in the first place. If you look at pre-COVID, they were always at about 26, 27%. It was only during because of increased volumes that it went up to 30. And I think we were very categorical in saying that 30% is not the sustainable margin going forward. So I think if we compare to the pre-COVID margins, we're already there. And we would like to continue, like I said, to stabilize at these margins.
Okay, always a pleasure talking to you, Ameera. Thanks so much for stopping by and giving us your details on your results, the way ahead as well. Wishing you and your team all the best, with regard to financials as well as taking care of all of us. For the time being, though, let's shift focus to our special segment where we get